this is Keith Schneider, CEO of MarketGauge.com, and it's July 10th, 2022 edition of Market Outlook. So, interesting week, despite a reversal in the rates here from its brief rally, markets seem to shrug that off. Let's take a look. Well, first of all, interesting pattern in the Qs. You've got a wedge pattern that we just recently, over the last 2 days, broke out above. So this is a very classic pattern, declining wedge, breakout to the upside, and we're exactly paused by the 50-day moving average. Now, what's interesting is across the board, we had a pretty good rally, closed above the 10-day moving average on all of the indices, and we're just now hovering under the 50-day across the board. So we did get this mean reversion, right? You can see real motion in mid-June got oversold along with price in the Dow. We got the same scenario in the Qs, right? A bit oversold on price and touching the lower end of the bands on real motion. So we've got a similar scenario here in the S&P, but of course we don't quite have the breakout. Now what's interesting is the Qs are down the most this year and actually are showing the strongest shorter term trading patterns at the moment. So this wedge here and this breakout is important, assuming that we actually can hold. So one thing you can do is definitely put in this trend line here, and you can see that we really need to hold that trend line in order to stay intact. So it'll be interesting to see how things play out. Now, one other thing to note, the S&P in terms of real motion is bumping up against that declining 50-day moving average, but it's now paused there. So if we get a failure, that would be consistent with obviously failing at key points. You can see the last rally also held at that declining 50-day moving average on real motion as well as price. So it'll be interesting to see what happens. However, again, what is interesting is that the Qs have already broken out of the wedge pattern. I would like to see at least one other key index break above that 50-day moving average, and that would probably confirm additional strength across the board in this counter trend rally in this bear market. Now, it's also interesting to look at the weekly charts because that's telling a different story. One thing you can see here is IWM is sitting just beneath its 200-week moving average. So small caps got hit the hardest. One thing you can see, the Dow holding its 200-week moving average. The S&P holding on to its 200-week moving average. And the Qs tested and, of course, bouncing off. So, again, if IWM can regain its 200-week moving average, we've got a situation where all four indices will be basically intact regarding its long-term trend. So let's see how that all plays out. Okay, now looking at one key intermarket relationship, we actually turned positive in terms of the risk gauge. And if we take a look, looking at the S&P versus utilities, we're just hovering under the longer-term trend line, right? We sort of had a new low on a relative basis, the S&P versus utilities, that ratio. Testing it, you've got a valid trend line here, and we're on the verge of breaking out from that. Now, regarding the ratio, the moving average has already crossed into positive territory. So that's interesting to note. And of course, we're still sort of in this wedge formation in utilities. And again, the outperformance of the S&P here on a relative basis, at least short term, is interesting to note. And of course, a bullish development, assuming it can hold. Now, moving on to volume analysis, one thing that is clear here as well is we got a nice improvement in volume patterns. So you can see here the NASDAQ 4 accumulation days outpacing the number of distribution days over the last 2 weeks. So with the exception of the Dow, all of the other 3 key U.S. equity indices are at least showing a positive sign here. Obviously, the Russell sort of in a neutral territory, but the NASDAQ and the S&P both have more accumulation days than distribution. And of course, you can see here the net performance over the last week was positive across the board. However, the Dow lagging by quite a bit, which is consistent with sort of the risk-on and more speculative stocks showing outperformance. The Dow was up only 0.84%, but it's populated by more value stocks than speculative growth stocks like the NASDAQ. So now, moving on to sector analysis, what's also pretty clear is speculative sectors definitely caught a bid, right? Semiconductors leading here, up 6.5% over the last 5 days. And what was lagging, of course, is utilities down 0.4%, with the S&P up over 3%. So again, technology, semiconductors, and consumer discretionary spending also up 4.5%, outpacing the benchmark index. So speculative sectors definitely leading the pop last week. Okay, now moving on to market hotspots and more of a global view, what's really clear is that, once again, spec sectors and clean energy definitely doing better. So clean energy up over 8%, solar up almost 8%, home builders catching a bid as well. So obviously money moving back into spec sectors. The other thing to note is silver, gold under a lot of pressure, and of course volatility on a short-term basis definitely got hit this week with the market rally. So net, you can see here we're definitely gaining some strength. Spec sectors and speculative areas of the market doing better. That is all a positive sign as we're paused under the 50-day moving average. All right, hope this all helps. See you next week, and bye for now.